Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at spillarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Episode 40 of Real Talk. We are smack in the middle of conference season. Just had the IMN Private Equity Conference last week in Laguna Beach. The Montage this week, it's Alice. Next week is NMHC. Couple weeks thereafter, YPO has different symposiums for various asset classes. So we're knee deep in conferences. But the takeaway from my personal takeaway from the IMN Private Equity Conference, we could have recorded the conversations from last year, January 2023, and play them in January 24 and save people a lot of travel and money and time. Look, it's always great to see people and reestablish relationships, which is the key to our business. It was the same talk. People disappointed by the lack of transactional volume the year prior, and they're hopeful that transactions will pick up this year. I feel like a broken record in office. We're seeing lenders take action, sell paper, and activity and volume is happening. If you have the stomach to buy office, which most of the institutional private equity world does not have. So it's family offices, syndication check writers who are going and buying very cheap office transactions. And in multifamily, it's just a lot of inaction. There's a lot of talk. There's a lot of conversations between lenders and borrowers. Lenders have not, for the most part, taken action. Sellers have not yet capitulated. There was talk about capitulation. An interesting theory was when the 10-year hit 5 in October, you started seeing sellers throw in the towel and selling. And then when the 10-year got down to 3.8, the sellers pulled back and said, wait a minute, why am I selling? I can survive. I can survive this. The 10-year has now come back up to, as we tape here, close to 4.15, 4.2. So we'll see what happens. Anyway, this week we've got John Drachman, co-founder of Waterford Property Group, discussing how he's staying alive until 25, the factors that he wants to see before investing in a new market, and an interesting conversation about not just finding capital, but finding the right capital for your transactions. I hope you enjoy my conversation with John Drachman.
Hello, welcome to another episode of Real Talk. I'm here with John Drachman, co-founder of Waterford Property Company. John, how you doing today?
I'm good. How you doing, Andrew?
I'm good. Let's see, 10-year treasuries off almost 90 bips from its high of 5. And I remember you and I were in San Diego for a YPO real estate conference, and people were freaking out. I think the 10-year just hit 5, and folks were wondering, where's the 10-year going to be 12, 18 months from now? And I don't know if you were in this part of the meeting, but I was never trust a lawyer for interest rate predictions. But I said, I think it's going to hit 3.5. And everyone's like, what the hell are you talking about? So now everyone who gave me shit for where I thought the 10-year was going, I send them screenshots of CNBC and the 10-year every day now.
Yeah, I know. I mean, I look, I think it's certainly been interesting to watch it. I laugh because I remember when it hit 4 and everybody freaked out, and now it's so hilarious as now people are like, oh my God, it's only 4. It's so great. So I think it's pretty hilarious kind of how psychology works, right?
Yeah.
So at least it's moving in the right direction. But no, I mean, I think that conference was literally right when it was peaking close to 5. And that was, I mean, people were pretty, upset, depressed, angry. I mean, I think there was a lot of emotion related to that. So I think it's certainly been good to see that come down. And I think it, hopefully will continue to, because it's, very hard to make stuff pencil in this environment with a treasury rate of 5%.
Yeah, well, I had never been to a YPO conference where the panic and concern was that palpable, and just around the whole industry at that October timeframe when the 10-year hit its high. There was a lot of concern of, I don't think we're going to get out of this. So I definitely want to talk about your views on the market, what you think the next 12-18 months is what your crystal ball of what it's going to be like. But first, for our listeners who may not know Waterford, why don't you tell us what your company does?
Sure. So Waterford Property Company, we're based down here in Orange County. We've been around really since 2014. So I co-founded the company with my business partner, Sean Rawson. We actually met through the NAIOP YPG program back in 2010. And we've done a lot of things over the years, but I would say we're primarily focused within the multifamily or residential spaces. So we've done everything from low-income tax credit development projects. We were very active in 2021 doing rent-restricted workforce housing projects. And then we've been very active in both market rate development and market rate acquisitions on the housing side. I have a background from my previous job before I started Waterford, which was the firm called Greenlaw Partners, where I did a lot of value-add office and industrial acquisitions. So we've kind of seen and done a lot. But I would say our firm's focus as we move forward, as we've come out of COVID, has really been to be very laser focused on projects where it has a residential focus to it. We primarily are based in Southern California. In terms of our projects, we've done almost $3 billion of transactions. And I think this cycle, our plan is to expand out of Southern California and to look into other markets.
So let's talk about other markets that you
Sure.
Are interested. What are the types of dynamics that you need to see in order to transact in that particular market?
Well, I think certainly if you're going to be focused on residential markets, you want to see population growth, right? I mean, that is something that I think when you look to markets where you feel like you can go create value or there's something that's unique to it, you want to see population growth. I think even when you think about low income tax credit development, which we do, when you're seeing population growth, a lot of times that can mean that rents are rising. And so there's more of a need for more affordable housing too. So certainly areas where you feel like population growth is growing is something that, we're interested in being on the residential side. So I think any markets like that. I think we're always going to try to be focused where we can get a little bit more micro focused within submarkets where we feel like we can either acquire, develop projects where we think the supply demand fundamentals are strong, where, one of the benefits we have, by the way, it's a negative if you're a tenant or trying to be a owner of a house, let's say in Southern California, is the fact that we do a terrible job here in California of building new supply. But it does benefit you when you think about the standpoint, if you own existing product, we don't build enough supply. And so it keeps vacancies low. It keeps, the power in a lot of the landlord's hands. And so I think we're always going to try to find areas where we feel like you're not going to see an overabundance of supply, which can be hard as you go out of Southern California, because a lot of the markets outside of California is much easier to build. But still, when you look at certain submarkets, you can find that while a general market might be easy to build in, there's a lot of specific submarkets where it might be more infill in nature, might be more built out, where you feel like, new supply is never going to, be a major issue for you.
So, this year has been, I like to call it just sort of the markets have just been frozen, right?
Yes.
The capital
Yes.
markets have been frozen. Institutional equity
Yes.
at best have been window shoppers, but really non-existent. So how have you, well, let me ask, I guess initially, have you transacted at all in the last 12 to 18 months?
So we've closed one deal since January of 2022. We
Wow.
bought a
So
land site.
for 24 months, you've closed one deal.
Correct.
Wow.
And in
Well,
2021, we did $2.5 billion of acquisition. So
how many deals was that for the 2.5?
we closed a little over, I think we did 4,600 units. We closed a large retail redevelopment site. I mean, we were really active. We were really active. I mean, since we started the firm, I joke that this year has actually been kind of nice because it's been slow. Like I feel like I've been active since about really the end of 2010, it feels like the market was just every year past that was very active on the acquisition side. First, taking advantage of the distress when I was at my firm, Greenlaw Partners, coming out of the GFC, then starting a company in 2014 where it was like, you had to try to find opportunities. And so really active there. And then, COVID hit. We weren't as busy in 2020. And then 2021, we really ramped up and we're very busy. So really, we haven't done anything. I mean, we haven't had a lot of conviction on a lot of opportunities recently. In 2021, we were really active acquiring assets in this workforce housing program where we were using long-term fixed rate financing to do that. So we thought that was sort of the play then. But as the markets have shifted, as the demand fundamentals have shifted and supply fundamentals have shifted, we just haven't seen a lot of things that make sense. I would tell you right now that feels like it'll be different in 2024. I've equated 2023 to what 2008 felt like, where it was the impasse year, right? Where it was like some people were still active, but then a lot of people weren't. And then 2009, if you recall, was really slow, but that was really when you saw some tremendous opportunities take place and happen. I'm thinking about some of the deals that closed in Orange County that were massive home runs in hindsight. But that was really when the thaws started to happen and some of the deals started trading. I think you'll see that in 2024. And I think we'll see that. So right now, I would say we're probably working on more live opportunities than we have been since really the end of 2021.
Yeah. And so how do you capitalize your deals on the equity side?
So we've done, I would say we've done it a lot of different ways. I mean, we've raised institutional equity where we've have, joint venture partners that are big real estate institutional equity funds that many people would know. We've raised capital from them. We have a couple family offices we've done business with. We've got a couple high net worth investors we've done business with. We've syndicated some deals in the past. Haven't done much of that lately. We've done, when you do light tech, you're doing tax credits. We've raised, tax-free municipal bond financing. We've kind of done it all. And it usually is we find a project or a strategy and then figure out what's the best way to capitalize it. So we don't have a fund. That's, I worked for a person named Wilbur Smith, who runs Greenlaw Partners. I consider probably one of the smartest real estate people I've ever been around.
By the way, I had lunch with him last week, and he's incredibly smart.
Yeah.
And although I don't know what he's doing in Orange County, I told him I feel like he came straight off the set of Yellowstone, driving his gigantic Ram pickup truck and hunt. He invited me to go hunt, and I'm like, I don't know if you want me to go hunt. With you.
Well, yeah. But the joke is, I tell people, like, when I worked for him, I learned how to hunt.
Yeah.
He likes real estate and hunting. And I was like, well, if I'm ever going to spend time with him out of the office, I'd better figure out how to hunt.
You better learn to hunt. But anyway, I'm sorry I cut you off.
Yeah, but he's very bright, very smart. And he always had this line that good deals find capital, so go find good deals, right? And so whenever we would be looking at opportunities or I'd be out in the market, his whole big thing with me when I was trying to find acquisition opportunities for him and, between 2010 and 2014 when I worked for him, 2009, he was always like, let's find great opportunities. I'll figure out, we'll capitalize it. There's enough capital that's out there, different forms of capital. And he's really, in my opinion, the master of that, very good at raising money, has a number of different equity sources. And so I really learned from him. And so we're really mindful of finding opportunities and then leveraging relationships to find capital and find the right type of capital, meaning sometimes opportunities are better suited for somebody who wants to have a long-term hold. Sometimes you find an opportunity that's more of a, let's buy it, let's fix it, let's sell it. And so it's really aligning those and finding the right capital.
Yeah. So have there been deals that you've wanted to transact on in the last 12 to 24 months that you couldn't because the capital just wasn't available because they didn't have conviction, or just the overall market you personally did not want to transact?
No, there hasn't really been much where I felt like we've missed out on opportunities, or there's something that we really wanted to do that we weren't able to capitalize. We haven't really seen that. And that's in large part, I just think sellers have been unwilling to capitulate. I think that I will tell you real time that is changing.
Yeah.
But where the markets were, where interest rates were, where the 10-year treasury was, where I felt like supply demand fundamentals were, as the market shifted, we just didn't feel, or I haven't felt, neither of my business partners, strong conviction on a lot of opportunities.
So as we close out 23 and head into
Yeah.
24, why do you feel that 24 is going to be a more active market? And by the way, you're not alone.
Yeah.
A lot of my clients uh, and contacts feel the same. And I don't know if it's just optimism by nature in the real estate. We're optimistic by nature, because if we even went back 12 months ago, I bet if we did this podcast December of 22,
Yeah.
I feel like we all would have said, yeah, 23 is going to be an active market. And then in the summer of 23, I think a lot of folks said, just wait till summer when we all get back from summer vacation after Labor Day activity. Didn't
Yeah.
see it. So what is it that you think is going to be different once the calendar strikes 24?
I think, well, so I've been saying for a little bit now, stay alive to 25.
Yeah.
And I've been saying that for about a year and a half. I wasn't that bullish on 23 being a good year, because I think when you go through one of these transition years, you've got that sort of standoff between sellers and buyers, where people have very different divergent views of where things are going. I think candidly, what we're seeing is happening now is you're seeing more forced sellers. So you're seeing people debt coming due. If you look at 2024 and 2025, there is a large amount of debt that's coming due, and there's really forced decisions. And so we're seeing it in very unique opportunities. We're seeing it in distressed office, where there's opportunities to buy distressed office, which we think have a long-term redevelopment plan on it. We're seeing it in existing multifamily, where groups have debt coming due, and they realize that the capital markets are very different from what they underwrote, and so there's opportunities on that side. And I think that I think it's debt, and I think it's the capitulation that things have changed, and that's really where I think you're going to start. Now, I don't think 2024 is going to be a robust year. I think we'll be more active, but I don't see it being a very robust year on the transaction side. I mean, it's going to be a while before we ever get back to the 2021 years. I mean, if you look historically, if you look at 2007, it took us till 2014 to get to the same level of transaction volume as 2007. So I think it'll be a while, but I do think there will be more transactions next year. And I think you'll start to see it improve in 2025 and 2026, just because there's going to be forced sellers. There's a lot of debt that's coming due, and it's a very different environment than what people underwrote. And you're starting, I think if you follow any of the real estate trade periodicals, you're starting to hear people handing the keys back. I mean, that's been happening on the office side for a while now. And you're starting to see people sell. And I think you're starting to see it on the multifamily side specifically too. So it's just happening.
Yeah, I mean, we've got two deals that are closing at the end of December on the office side, where we're representing buyers of loans that concurrently will have a deed in lieu in place. Yep. And so other office deals that we're on, where where we're on the borrower side, where borrowers have decided, look, there's no light at the end of the tunnel. It's going to take several years to recapture the equity that they've lost. And from a tax perspective, it's better for them to simply give the keys back now than fight for several years and not sure of what your outcome is. On the multifamily side, we've been involved on loan modifications and preferred equity deals and things of that nature. We still have not seen lenders enforce their remedies yet in mass, but we are expecting that to occur in 24. I guess let me ask, how is your portfolio heading into 2024, where you bought a lot in 21? Any concern with shorter term bridge debt?
No, I mean, we don't have any short term. I've got 2 loans that are due next year. One on an office building that, I mean, it's the office capital markets are a disaster right now, so that's an issue. On the multifamily side, We don't have any debt due next year. And so, our portfolio, a lot of our portfolio is rent restricted, tax exempt product.
Right.
So that product, in the environments like this has continued to perform really well. We don't have any near-term, short-term bridge debt. We haven't really taken on bridge debt since about 2019, 2018, and we paid it off or refinanced it all in 2020, 2021, 2022. I don't want to say we were smart, but I think my business partner and I sort of felt like at some point interest rates were going to have to rise. And so, our portfolio, where we feel very fortunate, our portfolio is in really good shape. A lot of almost everything we have is in Southern California. A lot of it's multifamily. And so, we get the benefit of still very low vacancy rates. The fact that, we're not oversupplying like a lot of these markets in other parts of the country are right now. We sort of took our lumps in 2020 through COVID. And I think, things seem to be performing, well. We're not seeing a lot of strong rent growth in our portfolio. Again, a lot of our portfolio is rent restricted. So, we don't even bake on rent growth. But, the markets in Southern California feel like I would call it fine. Certainly a concern of ours has been the operating expense inflation that we've seen. I mean, that's real. Any real estate has been experiencing it, but specifically multifamily. I mean, our insurance costs, our payroll costs, repairs and maintenance, but we're fortunate in California. We're able to, overcome that because we have strong vacancy or strong occupancy numbers. So our portfolio, we feel very good about. And so we feel like we've, positioned ourselves well to take advantage of this cycle, and, leverage it. And, I saw my old boss, Will, candidly, the GFC was really when Greenlaw, went from I would call it a regional player to a really more dominant West Coast player. And he leveraged, the GFC really well. And that's our plan at Waterford.
Yeah, no, absolutely. That's great to hear of how you guys are positioned. It's interesting that you're in Southern California. I'm in Southern California. You have a predominant Southern California based portfolio, yet most of my clients who sit in or live in Southern California, they have transacted outside of California. And we as a law firm who have transacted with that client base have probably 2/3 of our deals over the last several years are outside of California. I mean, I know some people are surprised to hear that, but you guys seem to have been a contrarian, especially, coming out of COVID, coming out of certain legislation like ULA and other governmental regulatory environment of both the state and the municipalities have caused people to move out of state. But you guys, at least for now, have chosen to have predominantly a Southern California base.
I think for us, we really like Southern California is hard. It's hard to be in the multifamily business, even in the state of California. Being a landlord is not a great position to be in. There's a lot of legislative nightmares. But if you are able to navigate the system here, we still deal with extremely low vacancy rates. We still deal with strong demand. We still are a market that's incredibly undersupplied from a new housing standpoint. There are still a lot of people there are people who are moving. I have friends who have moved to Florida. I have friends who have moved to Texas. I have friends who moved to Nashville. But there's still way more people who are continuing to live in Southern California. I mean, look at us, today, it's, another beautiful day. We've had a beautiful fall. And so I think in many ways, we like the fact that it's hard to do business here, because what it can do is it can insulate you a little bit. When you think about some of these other markets where I get really concerned on the multifamily side, when you think about markets like a Phoenix, right, where, my family has been involved in the Arizona real estate markets for, over 100 years. And I went to school at the University of Arizona. And, the challenge with those markets are they can build more supply. It's easier there. Easier doesn't always mean better in real estate. And I think that's, something that groups are going to learn this cycle. Something that was very apparent to me the last cycle is that, when you look at a market like Phoenix, they have a lot of new supply coming online, and that can impact. And even if you have continued positive absorption, can play an impact on the fundamentals of a real estate asset you own. And so, yes, California is hard to do business in. There's no doubt about that. But sometimes, again, easy isn't always a good thing. And as I tell, one of the things, I actually am a professor at USC. I teach a real estate entrepreneurship class, and I tell my students all the time, like, you want to develop specific knowledge, and you want to find and lean into harder areas of the business, because I think, one, there's potentially more financial reward in those, but two, there'll be less competition. So don't get scared about entitling a project in Los Angeles, which many people would tell you don't do. Well, you and I both know some of the people who do it, and some of them have been very successful because they've been able to navigate that and figure that out. And so that's how we sort of see the world. So now I know the interesting query is, so how do you go to other markets?
Yeah,
and
I was going to just ask, because you started our
Yeah.
podcast saying that you may go to other markets. So I guess I know you were tracking job markets that
Yep.
have job growth. So I guess the first question, why go to other markets, and are you able to speak about the markets that you feel could be good options for Waterford in the future?
Well, I think, one of the things I do feel like the long-term trends of people moving to certain Sunbelt markets, let's say at Dallas, I think those trends are here to stay. I do think you're going to continue to see people move into those markets. I think the business climate is going to continue to attract companies. And absent, a slowdown in the economy or something of that nature, my strong belief is that those markets are going to continue to attract people. And so I think that, yes, some of those markets are going to feel some pain for, getting overextending on themselves. And certain groups felt, I think, were way more bullish than they should have been. But if you study the absorption numbers, still some of the strongest markets with absorption are still some of the Sunbelt markets. And so I think those markets will continue to grow. And I don't necessarily see that changing. I could be dead wrong, because if you look at the GFC, those markets had a pullback in absorption, and they struggled during the GFC. And the markets that came back the fastest were San Francisco, New York, LA, Seattle. So, every cycle is different, but I think we're still focused on the fact that there is still strong absorption there. I think that's where some of the pain is going to be too. And so I think when we talk about, and we are talking to sellers in those markets have more debt that's coming due than, let's say, a Southern California. Sellers in those markets recognize the fact that cap rates are rising faster because of the new supply issues. And so I think they're going to get to a bottom maybe a little bit faster. And so you could see opportunities to acquire assets, below replacement costs and whatnot. The corollary, and I think what's really interesting, and Dallas is a perfect example of this, that's a market that's had really strong rent growth. And we've spent a lot of time with the Dallas Housing Authority, their HFC there, and they're trying to create and find ways to create more workforce housing. And that's something that we have an expertise in and understand how to do, and create rent restricted product using tax exemptions. And so through that run up, we think there's interesting opportunities there to do that work. Again, that's a unique sort of niche that we like. And so I think, if you see us doing stuff, you'll probably see us doing stuff in some of those markets in that vein, where it's more unique acquisition strategies that are not just, buying a traditional, call it 80s vintage asset and trying to improve it. So, but again, I think the positive story about some of these markets is, again, people are still moving there. Now, if that changes, then all bets are off. But for right now, they're still seeing good, strong in-migration of people, which is a benefit, right? You want those markets, you generally like to follow markets like that.
Yeah. Now, so it sounds like from your answer that you will do ground up construction on some of these affordable deals.
We have on the LIHTC side. I think one of the big things for us this coming cycle is we do want to get into the market rate development business.
Mm-hmm.
We also could potentially look at workforce housing, where you build projects that are focused more on people who make 61 to 120% of AMI, call it the missing middle. But getting into the development space on the residential side is definitely something that I think we'll be focused on. I think if you ask me one opportunity that we really like right now, and I don't want to go create a bunch of competitors, but we like infill land in Southern California. We think over the next couple of years, as we get through this correction and then the market turns, having good quality land sites are going to, potentially see, strong rebound in values. I mean, you've seen land almost get cut in half in Southern California, but it can swing back really quickly as it did last cycle. So I think, the development in land, I think, is something that we're focused on in Southern California. If you asked us where we're really focused here, because we still have a housing issue, like and you can't legislate our way out of this. And thankfully, now again, I'm going to say this and I might get crushed. It's getting easier to entitle projects in California. It's not easy. Don't mistake. You're not.
It's all relative, John.
All relatives, yeah. So we'll see that. But
all right. Well, I may have a deal for you of an infill land site of several hundred units in the South Bay area, which I'm sure you'll see come across. But I guess in our remaining minutes here, and you've spoken and alluded to the GFC a couple of times, and you talk about green laws. I guess expansion during the GFC days. Even my law firm was really created out of the GFC, where sophisticated users of legal services pushed back on the large firms that I came from and my colleagues came from, and we created this firm to assist real estate owner operators coming out of the GFC. And so I agree that there's a lot of opportunities there across all facets of the business. So when you're a professor at USC, and maybe I should call you professor and not John, Mr. Drachman. And so when you talk to your students who may be concerned about graduating during this time period, whether it's being in the real estate business and the law business, there are a lot fewer jobs today than 18 months ago. So what do you tell people who are coming out of school, whether it's undergrad or a graduate program, and they're starting now?
Yeah, and it's funny because I posted this on LinkedIn. I posted my story of coming out of USC's graduate real estate program in the May of 2009 and the struggles I had. And people seem to resonate with it because it was a tough time. And the reason I posted it, and I think it's an important topic, is if you and I have lived through a cycle before. And so we've seen it, and we know the sort of the harsh realities of real estate, that we're in a cyclical business. And that means there's ups and there's downs. And I think that the real message I am giving to sort of the students is this is normal. You entered a business that is very cyclical. If you don't like that, if you're not the type of person who likes big up and downs, doesn't like change, maybe real estate isn't the industry for you. It's not an industry that always goes up and everything seems like it's sunshine and rainbows. And so, but the corollary to that is that I don't know a lot of other industries that are, one, as entrepreneurial as real estate is, and two, that have the cycles we have. Because if you think about, let's say, the hamburger, I always joke about the hamburger business, right? McDonald's never comes out and says, hey, in 2021, we sold X amount of hamburgers, and in 22 or 23, we didn't sell any hamburgers. I alluded to on our call, that's Waterford, right? And as you know, sometimes the best deals you do are the ones you don't do. And there's never a time in McDonald's history where they're like, we shouldn't sell a hamburger. It's always, hey, we sold a billion hamburgers last year. Let's sell 1 billion and one next year, and let's always be growing.
Yeah.
Now, that's a harder business to break into. As you saw with your law firm, as I saw with my old boss, Will at Greenlaw, and a number of firms, these cycles have a way of creating a lot of opportunity. And I think what I tell my students, what I tell anybody who's going through this for the first time is, this is normal. One, don't be scared of it. Don't get upset with it. Process your emotions, but you have to hang on. You have to find a way to survive it. That's why I like that term, sort of stay alive to 25, is you have to find a way to stay in this industry, regardless of how you do it.
Yeah.
No one will judge you for what you do in these downturns to survive, but you have to, because at the end of every bad market's a good market. And so you want to find a way to survive. And hopefully, too, you're younger, you don't have, I always tell my students, I go, for as much as you think this sucks, there's a lot more people who have recourse loans coming due on a development project, and they're going, oh boy. And I go, that's a much worse position. If you're younger in this business, probably means you don't have anything major that's going on. You're just having a lifestyle. So just figure out a way to survive. And it doesn't have to be pretty. Maybe you take a job with a bank that you were like, I don't ever want to work for a lender, but you do that for 2 years because you just survive it. It's not pretty, but you've got to get to that next day, because what'll happen is it'll weed people out and there will be great opportunities. Because again, inevitably, after a bad market is a great market. I mean, from 2010 through 2020, I mean, it was a great market, right? You sometimes don't know it when you're in it, but then you look back, you go, that was a great market we had.
And it goes by quickly.
Oh yeah.
The buying opportunities that we're talking about, maybe 24, 25, it could last months. It may last a year and a half. It's not going to be forever.
But the only thing I would tell you on that point is, you still could have bought a lot of stuff in 2012, 2013, 2014. Sure. You bought industrial in 2015. You bought an industrial in 2017 and made a fortune. So I think there will be lots of opportunity, but I think for that next generation that the attitude has to be, if this is their first cycle, you've just got to find a way to survive. And if you do, there'll be a tremendous amount of opportunities for you. You've just got to find a way to survive. And that means getting creative. And that means maybe taking a different path than what you thought. And that's okay.
Yeah. Well, on that note, I mean, it's encouraging, despite a year or 2 years for with your company of buying just one deal, we're at culminating this period. There's a lot of concern. I'm doing all of our employees year-end reviews, and what I've been saying to them is, look, if Sklar Kirsh was the only law firm that had a reduction in number of deals, I would be concerned. But when you look at the entire legal industry, at least our peers, and everyone has had fewer deals, and you look at where you stand in the real estate business, and if your peers were doing deals and you're not doing deals, then you'd be concerned.
Yes.
So it's all relative to our peer group.
100%. It's just we get into cycles. This is the nature of real estate, and so you just kind of accept it and figure out a path and move on. And I joke, it's like, what really happens? We just make less money, right? Like that's just really, some people lose money in a cycle and we make less money. That's what happens. And so if you can find a way to survive on that, you'll be fine, because eventually we'll get to a good market again.
Yeah. And investors will applaud your conservatism in that you weren't just searching to do deals to feed the beast, to create fees.
I think there's going to be a lot of people who the line of sometimes the best deals you do are the ones you didn't do. I think there's going to be a lot of people who regret doing some deals in especially 2022 where they were aggressive and they should have recognized it's actually going to hurt them longer term more. That's when we saw the market shifting. I just remembered that from being in grad school and reading all these stories about the people who were really getting hurt in the GFC. And it seemed like all of them kept their foot on their gas far too long. And that was really the major problem with that. And so we've probably overextended to stopping stuff earlier, but I think we feel pretty good about it now.
Yeah. Well, John, I can't thank you enough for coming on to the show, being very candid about, your company and your thoughts on the market and your perspective of GFC days and what we're going through today. So I really appreciate it.
Of course. Happy to have the conversation.
And next year we'll have you on at the end of the year, and hopefully we'll talk about the number of thousands of units you purchased. And
that'd be great.
Good things. All right. Good luck to Arizona in your bowl game, and Happy New Year.
Sounds great.
All right, John. Take care.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.